All right, let's unpack this. Have you heard of a company that's consistently called the Amazon and PayPal of Latin America? Because that's precisely what we're taking a deep dive into today. Mercado Libre, which you might know by its ticker symbol MELI. This company has been making headlines, hitting all-time highs, and even jumping a staggering 12% in after-hours trading after releasing its Q4 2024 results, pushing its market capitalization past $117 billion. Now, you might be seeing these headlines, maybe you're tracking the stock, and you're probably wondering what's truly fueling this incredible momentum. Is this growth sustainable, or are we witnessing, a fleeting moment? And critically, what are the fundamental ins and outs of this company that's making such enormous moves in a region as dynamic and complex as Latin America?
Indeed. And what's truly fascinating here, I think, is how Mercado Libre hasn't just built a business. They've cultivated this pervasive, deeply integrated ecosystem. It really addresses core needs within the Latin American landscape. So our mission today is to cut through the noise, pulling directly from their latest financial reports for Q4 2024 and Q1 2025, alongside various analyses. We want to understand the foundational elements of their business, unpack their recent financial performance, and critically decipher what all of this means for its future trajectory and, well, for MELI stock valuation. We're going to explore not just what they're doing, but why it matters so profoundly, especially for you, the curious learner who wants that shortcut to being truly well-informed about this powerhouse company.
Okay, let's start with the big picture then, because that Amazon and PayPal of Latin America analogy, it really captures the dual power of Mercado Libre, doesn't it? It's not just one massive business, it's effectively two working in tandem, almost constantly fueling each other. So on one side, you have Mercado Libre itself. This is their core e-commerce marketplace. Think of it exactly like Amazon or maybe eBay. Sellers list products, buyers purchase them. Covers everything from fashion to electronics, much like any major global online retailer. And this platform is huge. In 2024, it alone generated over $50 billion in gross merchandise volume, or GMV. That's the total value of goods sold, which was a brand new record for them. It's basically the digital shopping mall for millions across the continent. Then, the other half of this powerful duo is Mercado Pago. This is their fintech platform. Conceptually, yes, similar to PayPal or Square, but its scope in Latin America goes far, far beyond just processing payments. It's really a full-fledged digital financial institution for millions.
And this raises a crucial question for anyone trying to understand their success. Why is this integrated model so exceptionally potent in Latin America? Why not just two separate companies? Well, the answer lies in addressing a profound and a pervasive market need. To put it simply, nearly half of the population in Latin America lacks access to traditional bank accounts.
Half. Wow.
Yeah, imagine that for a moment. No
Yep.
debit card, no easy way to send or receive money digitally, no access to credit. Mercado Pago strategically steps into this massive void. It provides access to digital banking, online payments, savings accounts that actually offer yield,
Yeah.
and other critical financial services that, frankly, many of us take for granted. This isn't just about convenience. For millions, it's about fundamental financial inclusion. It's a foundational need that traditional institutions have historically failed to meet. It really democratizes access to financial services.
Okay, here's where it gets particularly compelling. The brilliant, almost self-sustaining engine driving their rapid growth. They famously call it their flywheel effect. And it's genuinely ingenious in its simplicity and, well, its profound effectiveness. Picture this cycle. The more buyers that flock to the Mercado Libre e-commerce platform, drawn by the sheer variety, competitive prices, and the efficient logistics we'll get into, the more opportunities they have to seamlessly onboard those users into the Mercado Pago ecosystem for payments, for loans, and eventually for credit cards. This is crucial because, as you said, many of these users are unbanked, so Mercado Pago becomes their first step into the digital financial world.
Exactly. And conversely,
And conversely, yeah, the more users who become comfortable with Mercado Pago's digital accounts or credit cards, maybe because it offers better features or yields than traditional banks, or simply because it's their only accessible option, the more likely they are to use those new financial tools to spend money directly on the Mercado Libre marketplace. It's a continuous, self-perpetuating cycle, right? Where each segment's growth directly fuels the others. It makes the entire business incredibly sticky.
sticky, yeah, that's a great word for it.
It enhances customer loyalty, increases the frequency of use across both platforms. It's like a perpetual motion machine for growth.
That's precisely it. This integrated approach fundamentally enhances their stickiness compared to any standalone e-commerce or fintech platform. When customers aren't just using one service, but are deeply embedded in an entire ecosystem that addresses multiple daily needs from shopping to banking, it significantly boosts retention. and encourages higher frequency of use. This creates a formidable competitive advantage, a sort of invisible moat, if you will. It's about serving the entire transactional and financial life cycle of their users within one seamless, integrated platform, which makes it incredibly difficult for competitors to dislodge them. Consider a scenario. A small business owner in a remote village uses Mercado Pago to receive payments for their goods sold on MercadoLibre. They then use a Mercado Pago account to pay suppliers, manage their cash flow, and maybe even get a small business loan through the platform. This integrated journey makes them incredibly reliant and loyal to the entire MELI ecosystem, far beyond just buying a single product.
And this flywheel isn't just theoretical, it's translating into massive geographic dominance and strategic footholds. MercadoLibre operates in approximately 18 countries across Latin America. That's a truly vast market. Their largest revenue contributors are Brazil, Mexico, and their origin country, Argentina, which fascinatingly has a particularly unique story playing out, doesn't it?
Argentina presents a remarkable case study. It shows just how deeply integrated Mercado Pago has become into the daily financial lives of its users,
Yeah.
especially given the economic volatility there. With inflation rates soaring to over 100% last year, an almost unimaginable figure for many of us,
Unbelievable.
our sources reveal some surprising user behavior. We saw instances where workers in various industries would immediately deposit their paychecks into their Mercado Pago accounts.
Why? To get it out of the local currency.
Yes, exactly. To quickly convert their highly inflationary local currency into Mercado Pago's digital savings, which offers a yield. This allowed them to try and stabilize their funds against rapid depreciation, and then make purchases or pay bills through the platform. This isn't just about convenience. It powerfully demonstrates the critical role Mercado Pago plays in unstable economic environments. It becomes a de facto financial safe haven, a practical solution for a segment in the population desperately seeking stability. It shows how deeply intertwined the platform is with the daily survival strategies of its users.
Wow. Okay, so beyond the marketplace and the fintech arm, MercadoLibre has also made significant strategic investments in its logistics network. We're talking a massive physical infrastructure, their own trucks, planes, dozens of fulfillment centers. They opened over 10 new ones in 2024 alone. It sounds like an enormous undertaking, very capital intensive for what's primarily a tech and finance company. But there's a very specific strategic goal behind it, right?
Precisely. And it's crucial to understand that this vast logistics network is designed primarily to break even.
Break even, not make a profit.
Not intended to be a direct, significant profit center in itself, no. Its main purpose is to dramatically enhance the customer experience for both their e-commerce and financial services. By owning and optimizing their logistics, they can enable faster and more reliable shipping. In Q1 2025, for example, 50% of their shipments were delivered same day or next day.
50%. That's impressive for that region.
It's a game changer in Latin America, and it directly boosts the stickiness and attractiveness of the overall MercadoLibre ecosystem. It also allows them to control costs, especially for low average selling price or ASP items, making it economically viable to ship smaller, cheaper goods. So it's really an infrastructure play that reinforces their core businesses, making them more competitive, efficient, and ultimately more dominant in the market. It's a key part of their strategic moat.
Okay, let's transition them. Let's zoom in on the numbers, because this is where the real story of accelerating momentum unfolds. MercadoLibre had an absolutely stellar 2024, and it unequivocally carried that impressive momentum directly into the first quarter of 2025. What do the latest reports, hot off the press, tell us about their recent financial performance? Because it's quite a narrative of sustained, profitable growth. Let's start with Q4 2024, which really set the stage. The financial snapshot was, quite frankly, remarkable. Net revenues and financial income hit $6.1 billion. That's a robust 37% increase year over year. But here's where the context becomes critical. On an FX-neutral basis, meaning after accounting for the often significant currency fluctuations in Latin America, that growth rate absolutely exploded to 96% year over year.
96%.
Yeah. This isn't just good growth, this is phenomenal. It truly highlights the underlying organic strength of the business, despite facing those currency headwinds. Their operational efficiency was also strong. Income from operations reached $820 million, boasting a healthy 13.5% margin, and net income landed at $639 million with a solid 10.5% margin. Digging deeper into the volumes, their total payment volume for Q4 also reached $58.9 billion, up 33% year over year, or an impressive 46% FX neutral. While gross merchandise volume was $14.5 billion, up 8% year over year, which translated to a remarkable 56% FX neutral. This means their core business was simply booming. Moving into Q1 2025, the momentum largely continued, showcasing a broadly sustained trend. Net revenues and financial income came in at $5.9 billion, maintaining that strong 37% year-over-year dollar growth.
Still 37%.
Yep. On an FX-neutral basis, growth was still very robust at 64% year-over-year. While this showed a slight deceleration from Q4 2024's extraordinary peak, it's still an incredibly strong growth rate for a company of this scale. In terms of profitability, income from operations for Q1 2025 was $763 million, marking a 45% year-over-year growth with a 12.9% margin. And net income was $494 million, growing 44% year-over-year with an 8.3% margin. So consistently solid numbers across the board.
Yeah, and if we connect these numbers to the bigger picture, you might observe a slight margin compression in Q1 2025 compared to Q4 2024. You saw the income from operations margin move from 13.5% down to 12.9%, and net income margin from 10.5% to 8.3%.
Right, what was driving that?
Well, this wasn't really a sign of weakness or deteriorating fundamentals. Instead, it's attributed to several deliberate strategic factors. Increased strategic investments in key high-growth markets like Brazil and Mexico, the ongoing impact of currency depreciation in some regions, and higher interest rates in Brazil. Furthermore, they are strategically investing in expanding their shipping network and aggressively scaling their credit card business, which involves upfront costs. So this isn't a sign of weakness, but rather a calculated reflection of their commitment to long-term growth and market expansion. They're prioritizing those strategic investments, even if it means a temporary slight impact on short-term profitability metrics. It's basically a trade-off for future gains.
Makes sense. Okay, beyond the impressive top-line numbers and profit margins, their key performance indicators, the KPIs and user adoption rates, really paint a compelling story. It's about accelerating reach and deeper engagement. In 2024, MercadoLibre achieved truly significant milestones. For the first time ever, they passed over 100 million annual unique buyers on their marketplace.
100 million buyers.
Think about that scale. 100 million individual people purchasing from their platform in a single year. And on the fintech side, they passed over 60 million fintech monthly active users, or MAUs. These aren't just vanity metrics. They represent a massive expansion of their engaged user base across both core segments of their business. And this growth in user acquisition is actually accelerating. In Q1 2025, unique active buyers reached 66.6 million, which is up a phenomenal 25% year over year.
That's faster than before.
Yeah, what makes this particularly noteworthy is that this is the fastest growth rate they've seen since Q1 2021, which you'll remember was during the peak of the pandemic-driven digital acceleration. It strongly indicates that their ongoing investments in enhancing their value proposition, whether it's faster shipping, better credit offerings, or new products, are truly paying off. They're attracting new users at a rapid clip. This metric, by the way, had already been accelerating for 3 successive quarters in 2024, reaching 24% year over year in Q4. So it's a consistent trend. Their fintech monthly active users also continued their strong trajectory, reaching 64.3 million in Q1 2025. That's up 31% year over year.
Still very high growth.
Very high. While this particular growth rate shows a slight deceleration from prior quarters, for instance, it was 34% in Q4 2024 and 38% in Q1 2024. It's still what you'd comfortably call startup rates of growth for a company of this immense scale and market leadership. Even better, the data shows that high-frequency users, the ones most deeply engaged with the platform, are growing at an even more accelerated pace. That shows deeper loyalty and integration into their daily lives. Looking at their volume metrics, which really show the pulse of the ecosystem, their gross merchandise volume, the total value of goods sold on their platform, surpassed an incredible $50 billion for the first time in 2024.
$50 billion, wow.
In Q1 2025 alone, GMV reached $13.3 billion, up 17% year over year, or a solid 40% on an FX-neutral basis. And total payment volume, the sum of all transactions using Mercado Pago, was a staggering $58.3 billion in Q1 2025. Growing 43% year over year, and an even more impressive 72% FX neutral. These are truly massive numbers that underscore their market dominance.
And what's particularly insightful here is how this robust growth manifests across different regions within Latin America. While the consolidated numbers are undeniably strong, the nuances of regional performance in Q1 2025, especially when looking at FX-neutral year-over-year growth, highlights specific strengths and their strategic responses to market dynamics. Argentina, for example, despite its famously volatile economic environment, showed truly tremendous performance.
You mentioned that earlier, yeah.
Net revenue grew an astounding 184%, GMV increased by 126%, and items sold grew by 52%. This remarkable recovery in consumer demand and engagement helped counterbalance the increased strategic investments they were making in other regions. The supermarket category in particular was a significant highlight. Regional supermarket items sold grew a robust 65% year-over-year in Q1 2025. It shows that even in challenging conditions, the essential nature of their service can drive impressive results. Brazil, which is MercadoLibre's largest market, continued its robust trend with net revenue growth of 41% and GMV growth of 30%. This consistent performance in their biggest market is a critical pillar of their overall success. Mexico, another absolutely key market for them, posted very strong net revenue growth of 51% and GMV growth of 23%. Though it's worth noting that growth in Mexico did experience a slight slowdown in one high average selling price, or ASP category, early in Q1 2025, which the company has publicly stated they're actively addressing with targeted initiatives, demonstrating their responsiveness to market shifts.
So what does all this mean for their market share gains? Because that's really the ultimate competitive test, isn't it? It's absolutely critical to note that MercadoLibre isn't just growing in a vacuum. They are actively gaining market share in incredibly competitive markets like Brazil and Mexico.
Right, against the big global players.
Exactly. And they're doing this against formidable global players, household names like Amazon, Shopee, and Walmart, all vying for the same digital commerce space. And here's the kicker. They're achieving this while maintaining and even expanding their profitability. This isn't just about throwing money at growth. It's a testament to the enduring strength of their core value proposition and their brand preference, which, by the way, reached all-time highs in Brazil, Mexico, Argentina, and Chile in Q1 2025. It suggests they've built a truly sticky platform that resonates deeply with Latin American consumers and merchants. Okay, let's pivot slightly and unpack the financial services beast that is Mercado Pago. It's truly a comprehensive fintech powerhouse covering almost every financial need imaginable for individuals and businesses across Latin America. This is so much more than just a payment processor. It's a critical component of their dual value proposition. Mercado Pago offers an incredibly extensive range of services. For individuals and small businesses, they provide direct loans. It truly acts like a bank for millions, allowing users to make deposits, hold funds, and even invest directly through the platform. They issue credit cards, in fact. During the crucial Black Friday period in Q4 2024, the Mercado Pago credit card was the most used card on the marketplace in Brazil.
That's a strong signal.
Absolutely. They also provide insurance products, and of course, they facilitate all manner of online and digital payments, including offering point-of-sale devices for physical merchants, enabling them to accept digital payments too. It's a complete ecosystem.
And what's particularly fascinating here is their profoundly disruptive value proposition, especially concerning deposits. In a region where incumbent banks have historically offered incredibly inferior, often zero, yields on deposits with high fees and often requiring minimum balances that many cannot meet, Mercado Pago stands out dramatically. They offer a yield on deposits that often matches or even exceeds benchmark rates. And crucially, it's available from day one with immediate liquidity. This is a game changer. Their advanced technology and low cost-to-serve model allow them to offer these highly competitive yields profitably and at immense scale. This isn't just a competitive advantage for MELI, it drives massive positive externalities across the entire ecosystem. It attracts new users, makes existing users incredibly stickier, encourages deeper engagement with other digital account products, and naturally increases purchase frequency on the marketplace as users consolidate their financial lives within the Mercado Pago app. It's a powerful example of how their financial inclusion mission translates directly into strategic business advantage.
Okay, now let's talk about their credit portfolio. This is a key growth engine for the company for sure, but it's also one of the more complex aspects for investors to fully grasp, precisely because of how it impacts their reported financials and cash flow. It's an area where understanding the why is paramount, wouldn't you say?
Absolutely. You really need to look under the hood here.
So Mercado Pago's credit portfolio has seen truly incredible rapid growth. It reached $6.6 billion in Q4 2024, marking an impressive 74% year-over-year increase. This robust growth continued into Q1 2025, hitting $7.8 billion, which is a 75% year-over-year increase. Just to give you a sense of the scale, Brazil alone contributed over $800 million to this portfolio quarter over quarter. Their assets under management, or AUM, that's the total value of assets they manage for the users, also showed what analysts are calling phenomenal growth, reaching $10.6 billion in Q4 2024, up a staggering 129% year over year.
129%.
And continuing to grow to $11.2 billion in Q1 2025, up 103% year over year. These are huge numbers that show the scale of their financial services ambition. This rapid growth in the loan portfolio might seem like a simple spending of money, but it represents a truly significant strategic investment for Mercado Libre. For example, in 2024 alone, they lent out a net of nearly $3 billion to expand their loan and credit card portfolios. You might look at this and think about large cash outflows impacting their free cash flow, but it's vital to understand this from a growth capital expenditure perspective, right? Similar to how a traditional business invests in a new factory or machinery for future production.
Exactly. And this raises a truly important question for investors trying to analyze MELI stock. How do these lending activities impact reported profits and, crucially, cash flows? The key insight here lies in accounting standards. For lending businesses, provisions for potential loan losses, essentially money set aside to cover loans that might not be repaid, are required to be set aside immediately upfront when a loan is originated.
Upfront. Got it.
Right. However, the revenue and profits generated from these loans are recognized slowly over the entire life of the loan as payments come in. This creates a significant timing mismatch. A large upfront cash outlay and accounting charge, followed by gradual revenue recognition.
So growth looks expensive in the short term.
Precisely. This means that rapid growth in the credit business, while a calculated strategic investment for substantial future returns, can make reported profits appear significantly lower in the short term. And cash flow statements might even show negative figures, specifically in the investing activities section. It's much like a capital expenditure for growth. You invest heavily today to build a future revenue stream. Think of any rapidly expanding business that needs to invest heavily upfront in new infrastructure or inventory before seeing the full returns. A good example, to provide some context, would be a company like GoEasy, a Canadian financial services company known for consumer lending. Their cash flows on the statement often appear negative, precisely because they are constantly lending out massive amounts of money to rapidly grow their loan portfolio. This upfront investment is absolutely essential for generating future revenue and profits, but it can temporarily mask the underlying profitability in the short term, which leads some analysts to misunderstand this aspect of MELI's financials.
Despite this rapid growth, it's critical to assess the asset quality and profitability of their credit portfolio, and the picture here remains robust. Their net interest margin after losses, or NIML, which essentially represents the net spread between their credit revenues and all associated costs, including provisions for doubtful accounts and funding costs, stood at 22.7% in Q1 2025.
Okay, 22.7%. How does that compare?
Well, this is a compression from 31.5% in Q1 2024.
A drop then.
Yes, but this compression is primarily due to several factors. Negative seasonality quarter over quarter, a continued strategic move upmarket for consumers and merchants, meaning they're lending to more established, lower-risk profiles, and a higher share of credit cards in their portfolio, which increased from 35% in Q1 2024 to 42% in Q1 2025. Credit cards, while strategic, often have different margin profiles initially. However, the underlying spreads and asset quality remain very robust, indicating prudent lending practices. Crucially, they're non-performing loans, or NPLs, that's the percentage of loans where borrowers aren't making payments, a key indicator of credit health, have actually shown year-over-year improvement.
Improvement, that's good.
Yes. The 15-90-day NPL, meaning loans that are 15 to 90 days past due, stood at 8.2% for the portfolio as a whole in Q1 2025, remaining well within the same tightly managed range as the last 12 months. And remarkably, first payment defaults on credit cards in Brazil, which is their largest individual credit portfolio, hit an all-time low in March 2025.
An all-time low.
Wow. This is a powerful testament to their effective use of advanced data analytics and their ability to target creditworthy marketplace buyers who are tens of millions of users already engaged within their trusted ecosystem. It demonstrates their sophisticated underwriting capabilities.
Okay, here's where it gets particularly insightful, though. And it's something to keep a very close eye on if you're analyzing MELI stock or considering an investment. While the credit business is undeniably a powerful growth engine, it introduces a unique consideration, what some might even call a red flag for investors to constantly monitor: direct credit risk. This is a key distinction, isn't it?
It really is.
Unlike, say, the Apple credit card, where a financial institution like Goldman Sachs is the actual lender and bears the risk if a borrower defaults on payments, Mercado Pago is the actual direct lender for its credit cards and other loan products. This means that if a user doesn't pay back their loan or credit card balance, Mercado Libre directly bears that financial responsibility. They are on the hook for those losses, not a third-party bank. This puts the credit risk squarely on their balance sheet.
And this raises a truly important historical parallel, one that often comes up when discussing conglomerates venturing deeply into financial services. Think about General Electric and its once dominant GE Capital segment.
Right, GE Capital.
For a long time, GE Capital was a massive driver of growth and profit for GE, operating almost like a bank within the industrial conglomerate. However, when the 2008 financial crisis hit and credit markets imploded globally, GE Capital's collapse severely hurt the entire General Electric company, ultimately leading to its significant restructuring and eventual breakup.
A cautionary tale.
Very much so. The lesson from this historical example is clear. While direct lending can drive immense growth and profitability, it also introduces a significant layer of systemic risk, especially if credit standards are loosened or if economic conditions deteriorate sharply. So the key insight for you, the listener, and for anyone considering MELI stock is this. While this direct lending is not an immediate problem for MercadoLibre today, and indeed their asset quality metrics look strong, it's a relatively newer and rapidly expanding part of their business. It is therefore crucial to monitor its evolution.
What should we look for?
If you start to see any signs of the company loosening up credit standards, for instance, relaxing their underwriting criteria, or indiscriminately issuing a massive increase in credit cards without maintaining strict underwriting standards and strong collection practices, that would be a significant red flag. It's a key metric for you to watch very carefully if you're considering an investment in MELI stock for the long term.
Got it. Okay, so we've thoroughly explored the business model, the impressive growth, and the dual engines of e-commerce and fintech that power MercadoLibre. Now, let's tackle the ultimate question for investors. What about MercadoLibre's overall financial health? And is MELI's stock a good value right now, especially considering it's been trading at all-time highs? First, let's look at their overall revenue and profitability trends, which are incredibly compelling. As we discussed, they're showing consistent 30% plus year-over-year revenue growth, including an impressive 37% in Q1 2025. To put that into perspective, a global giant like Amazon's revenue growth in its most recent quarter was less than 1/3 of MercadoLibre's growth rate.
A much faster growth.
Much faster. The significantly faster growth is fueled by two primary factors: the inherently faster economic growth within the Latin American region and the accelerating adoption of e-commerce and fintech services that are still very much in the early stages of penetration there. What's equally, if not more, impressive is their operating profit margin. It has shown consistent expansion, reaching a robust 12.66% on a trailing 12-month basis as of Q4 2024.
Strong margins.
Very strong. These margins are actually quite comparable to, or in some cases even better than, Amazon's operating margins. This is incredibly important for you to understand because it stresses that MercadoLibre isn't merely chasing growth at all costs. It's pursuing profitable, sustainable growth. We've seen plenty of examples of what can only be described as disasters for investors, companies that prioritize top-line revenue growth without a sound financial foundation or a path to profitability. MercadoLibre is clearly demonstrating that their growth is built on solid financial footing, which is exactly what you want to see for long-term investment in MELI stock.
And for me, a particularly compelling metric that truly speaks to the quality of the business is their returns on invested capital, or ROIC. MercadoLibre has shown an impressive, almost transformative improvement in this area, moving from a modest 8% to a strong 22% in just 5 short years based on Q4 2024 data.
From 8 to 22%, that's huge.
It is. Furthermore, when we look at the ratio of their ROIC to their weighted average cost of capital, or WACC, which is essentially the minimum return a company must earn on an existing asset base to satisfy its creditors and shareholders, it stands at an excellent over 2.1.
Over 2 to 1, okay.
This is a clear indicator of highly efficient use of their capital to generate returns.
Yeah.
A crucial sign of a very well-managed, high-quality business that is consistently creating shareholder value.
Okay, now let's dive into cash flow, which, as you mentioned, can sometimes be tricky to interpret for rapidly growing companies like MercadoLibre, especially when they're making such substantial strategic investments that are designed for long-term paybacks. This is where some of the misunderstanding about MELI stock valuation can arise. From a Q4 2024 perspective, MercadoLibre reported adjusted free cash flow of $1.3 billion for the full year 2024. However, it's absolutely critical to understand that this figure was after they made incredibly significant growth investments, $860 million in capital expenditures, primarily for their rapidly expanding logistics network, and nearly $3 billion in fintech funding, mostly to expand their credit book. So that $1.3 billion is what was left after they plowed billions back into the business for future growth. It doesn't tell the whole story of their underlying cash generation.
Exactly. And this is where the concept of true cash flow potential becomes incredibly relevant for sophisticated investors. Our analysis suggests that if the company were not investing so aggressively today for future growth, meaning if they had simply maintained their existing operations without expansionary capex or credit book growth, MercadoLibre could have produced approximately $5 billion in free cash flow in 2024.
5 billion compared to the reported 1.3.
Yes, and it's worth noting that independent AI analysis also converged on a remarkably similar range of $4.7 billion to $5.6 billion for this unshackled or normalized cash flow. This perspective is vital because it reinforces the enormous underlying cash generation capability from their mature marketplace and established fintech operations. It illustrates what the business could deliver if it chose to slow down growth investments and prioritize immediate cash return. Looking at Q1 2025, we did see an adjusted free cash outflow of -$10 million.
Negative 10 million.
Yes, but this was seasonally low, as the first quarter often is for many businesses, and it included substantial ongoing investments. $256 million in capital expenditures for logistics, and a significant $770 million in fintech funding, again, largely for the continued expansion of their credit book. Despite this short-term outflow in adjusted free cash, their net cash provided by operating activities was a very strong $1.031 billion.
Still over $1 billion from operations.
Exactly. While this was down from $1.513 billion in Q1 2024, it still demonstrates robust underlying operational cash generation. It provides a solid foundation for continued future growth, even with heavy reinvestment. It's a testament to the fact that their core operations are generating substantial cash, which they are then intelligently deploying for future expansion.
Okay, so bringing it all together then. What does all of this mean when we talk about MELI stock's price? Is it a buy at its current valuation, especially after hitting all-time highs and seeing that big jump? This is what everyone wants to know. Let's put the market cap into perspective. At the close of Q4 2024, MercadoLibre's market cap was around $105 billion, which then surged to $117.6 billion after after-hours trading, reflecting the market's positive reaction to their strong earnings report. Now, based on that $5 billion true free cash flow potential we discussed for 2024, the business was trading at roughly 23.5 times that potential cash flow.
23.5 times.
Yes. For a company that is consistently growing its revenue by over 30% year over year, this multiple is actually considered quite cheap by some analyses. It suggests that despite trading at all-time highs, the stock might still be undervalued relative to its robust underlying cash-generating power if those growth investments were to moderate. When we look at a discounted cash flow or DCF analysis from a Q4 2024 perspective, one particular analysis suggested a fair value of $1,884 per share compared to the then current market price of $2,134.
So slightly above fair value by that measure.
Right, indicating it was technically slightly overvalued at that moment. However, for a volatile business operating in dynamic economies like those in Latin America, this spread is often considered within the margin of safety. It's important to remember that these economies can be less stable than, say, the U.S. economy, so a slightly larger margin of safety might typically be preferred by some long-term investors. Furthermore, looking at other commonly used multiples from a Q4 2024 context, at a forward price-to-earnings (PE) ratio of 33x and a price-to-free cash flow (PFCF) of 15, the stock also looked cheap compared to its impressive growth and profit profile.
15 times PFCF potential is quite low.
It really is. You would scarcely find a business with this kind of growth, profitability, and market leadership selling at these valuations in many other global markets. These metrics suggest that the market might still be underestimating its long-term potential.
So, synthesizing these different valuation perspectives, it becomes clear that while some investors might prefer a larger margin of safety when considering a long-term buy and hold, given the economic volatility in Latin America, the overall consensus from the provided analysis points strongly to a buy rating for MELI stock.
A buy, even at these levels.
That's what some analyses suggest. It's consistently seen as an excellent business with strong underlying fundamentals and incredibly robust growth prospects, despite it trading at all-time highs. The company is often described as misunderstood by some analysts, particularly with its increasing focus and substantial investment in the lending side of the business, which, as we've discussed, requires a nuanced understanding of its cash flow dynamics and accounting treatment. The bottom line is that MercadoLibre is seen as a very profitable business that is currently not selling at an overly high price, especially considering its impressive growth prospects, its strategic market position, and its vital role in a rapidly digitizing region. It represents a compelling blend of scale, growth, and profitability.
So there you have it, a truly in-depth exploration of MercadoLibre. It's a company that's not just successfully blending e-commerce and fintech, but creating a powerful, self-reinforcing ecosystem in a rapidly digitizing and underserved region. And its impressive stock performance is a testament to that underlying strength and strategic foresight.
Absolutely. We've seen how its significant strategic investments, particularly in its extensive logistics network and its rapidly expanding credit portfolio, are designed to drive substantial long-term growth and solidify its market position, even if these investments temporarily influence short-term cash flow metrics. The company's remarkable ability to consistently expand its user base, grow transaction volumes, and expand its profitability, all while skillfully navigating a complex and often volatile regional economic landscape, truly positions it uniquely. For you, the listener, remember the key insights: the incredible strength of its interconnected flywheel effect, the critical role it plays in providing essential financial services to the unbanked, and the careful balance it must continually strike with its direct lending exposure. These are the nuances that set MELI apart.
It's a story of incredible momentum, market leadership, and a future ripe with opportunity across a vast continent. But as with any deep dive, there's always more to consider, more questions to spark your own curiosity. So here's a provocative thought for you to mull over, one that looks far beyond today's headlines. Mercado Libre's journey has fundamentally been about democratizing access to commerce and financial services for millions who previously had little to none. The profound question for the long term isn't just if Latin America will continue its digital transformation, but how much of that vast, unbanked, and digitally hungry population Mercado Libre can continue to capture and monetize, especially as its credit portfolio matures, as its logistics network becomes even more efficient, and as that flywheel spins even faster. What new, perhaps entirely disruptive services might arise from this unique and deeply entrenched position in the years to come? And how will its direct lending model ultimately shape its long-term identity and financial stability as it continues to evolve? Thank you for joining us on this deep dive into MELI stock. We truly hope this exploration has given you new insights and those valuable aha moments to carry forward in your understanding of this remarkable company.